Valuing a company is one of the most difficult tasks when it comes to investing. If this is something that you've been struggling with, stick around because in this video I'll be covering one of the tools that I use to calculate the intrinsic value of a stock. Simply put, this is a widely used method to determine whether a stock is undervalued or overvalued. Intrinsic value is simply a measure of what an asset is actually worth. This helps us as investors because this will help us to determine whether a stock is trading for cheap or are we going to overpay at a certain price. Stick around because I'll be sharing with you guys how we can actually determine the intrinsic value of a stock using one of my favorite methods, which is called the discounted cash flow model. Just remember that this is simply one way of valuing a stock, and this just forms part of my method of fundamentally analyzing companies before I invest my hard-earned money into that said company. Investing in a company just because of the price or the price to earnings ratio or the way the graph goes up or down on Google Finance really isn't a very good investment strategy. So you need to have the knowledge to analyze a stock before you can actually invest in it. So I'll show you the inputs that we need to know, the stuff that we need to understand, and how it actually plays out at the end. I'll show you guys an example so you can hopefully follow along and get a good idea of how it actually works. I'm going to simplify the numbers to keep the video as short as possible, and this is just an indication of how it can work, but there's quite a lot of variables that can be involved in the sheet. And just remember, unfortunately, there's no exact way to predict the value of a company without putting in a few educated guesses, and that's why it's important to make as accurate guesses as possible. So first of all, when I open the sheet, you'll see a few things that pops up. First, we'll need to get the relevant information, which will be our inputs for this specific sheet. The things that we'll have to know is the growth rate of the company. I'll explain that just in a minute. We need to know what the discount rate will be. This is simply the return that we will expect over a certain period of time. And we need to have a terminal value or a multiple of the free cash flow for this company. Usually 10 is a good starting place because quality companies can be sold for 10 times free cash flow in the future. Then we have to know what the first year of free cash flow is for this specific company. Next, we need to know all the excess capital or cash that this company has available. So what I've done is I've added a part where we can enter the stock ticker, and for today's video we are going to use Apple for this example. So first of all, everything starts with the growth rate. The growth rate is basically the percentage which the company will grow its revenue. So like I said, there's a few variables when it comes to the discounted cash flow model, and we are going to work with revenue growth. So the first thing that we need to input is the growth rate of the company. So this is a very important part because if I think that Apple will grow at 50% every year, this will obviously change the numbers quite a bit. So it's very important to get as accurate numbers as possible. What I like to do is to go to Yahoo Finance, and we can go to the analysis tab, scroll down to the bottom, and we can see that the growth estimates for Apple for the next 5 years will be 8.13%, and the past 5 years has been 21.91%. What I like to do is I like to add the two together, meaning it's 8.13 plus 21.91 divided by 2, which gives us a growth rate of 15.02%. So we're going to put in 15.02%. This is a good start, and obviously 15% revenue growth year over year is quite good growth. So I'll jump back to this in the end to show you what the differences can be if we change just this number. Next, we have to figure out what our discount rate is. The discount rate is simply the rate or return that we expect over the term of our investment. In this case, I would like a 15% return on investment year over year. Compounded, that will create a lot of money. Again, if we would put in a discount rate of 10%, I'll rather just invest my money in the S&P 500 ETF that on average returns around 10%. So we obviously want to do better than that. So I'll put in 15%. Next, we have to put in the terminal value or the multiple of the free cash flow that we will be able to sell the company in the next 10 years. So this simply means if a company like Apple generates $100 billion in free cash flow in year one, we need to be able to understand what we will be selling the company for in 10 years. Because Apple is quite a large and significant company, we will be using a terminal value of 10, meaning we'll be selling the company for 10 times free cash flow in the future. So with that out of the way, we need to figure out what the first year of free cash flow is for Apple. There's a few ways that we can do this. We can either jump to Yahoo, but I like to use Stock Unlock. This is a subscription-based service which can help you with your investing quite a bit. What I'm going to do is I'm going to jump to its financials and I'm going to jump to the cash flow statement. At the bottom, it will show me free cash flow. Here we can see that Apple generated a free cash flow amount of $111 billion in the 2022 financial year. So we'll put that in at this tab. And then next we need to know the excess capital or cash that Apple has available. Again, we can find this on Stock Unlock. We'll jump to the balance sheet and we'll scroll down to where it shows total cash. Here we can see that Apple generated a total cash amount of $48 billion, and that's what we are going to input over there. We can see the present value of future cash flow, and we can see the intrinsic value or the market capitalization, which includes the total cash position, or the intrinsic value, which is the enterprise value, which does not include the cash position. So using all of this growth rates, with our discount rates, with our terminal values and the free cash flow as well as the capital, we can see that the intrinsic value or the market cap of Apple at the moment is $2.2 trillion. And using the market cap, we can see whether the company is overvalued or undervalued. There's one last step that we need to understand before we determine whether the stock is cheap or not, and that is using a margin of safety. What we've done so far is determine the actual market cap of Apple. So here we can see that the intrinsic value of Apple is $2.27 trillion. When we go to the general tab and we have a look at the market cap of Apple currently, we can see that it is $2.41 trillion, which means that it is currently overvalued. This means that with the excess capital and the free cash flow used in this discounted cash flow model, that the actual market cap is around 2.27 trillion and not 2.41 trillion. So this means that the value of the stock is This means that it is valued more than what its cash flow can project in the future. Again, with the last step that we need to add is our margin of safety. If we would buy a house which is listed for R1 million and we know that it's actually worth R1 million, we don't want to buy it for R1 million. We want to buy it at a discount. This is where your margin of safety comes in. If you made incorrect projections with your growth rate or maybe your discount rate or your terminal value, the margin of safety will help you to kind of balance everything out. Let's change this up and change the growth rate to around 25%. This will show that the intrinsic value or the market cap of Apple is around $4.4 trillion. And if we compare this to the actual market cap of Apple, it will seem like Apple is undervalued. So this is really quite important to kind of make the best educated guess as possible, because using inflated numbers can really mess up your evaluation. This is just a way of protecting yourself if you are wrong. Again, there's no way to predict the future. There's no way to predict every single part of a running business of this size. So that's where your margin of safety helps you for if you are incorrect. So when using a margin of safety, you might choose anything from 10%, 15% or 30%. Obviously, the higher your margin of safety, the better, but it's nearly impossible to find a company with a margin of safety of, let's say, for example, 50%. So what I'm going to do is I'm going to use a margin of safety of 15%, which shows that the ideal market cap of Apple would be $1.9 trillion. So currently it's trading at $2.41 trillion, which means that it is currently overvalued by around 25%. 1.93 trillion plus 25% is around $2.41 trillion. So again, if we wanted to buy a company like Apple and receive a return of 15% for the next 10 years, we would have to buy the company for $1.9 trillion instead of what it's actually trading at the moment, which is $2.41 trillion. The idea of using the discounted cash flow model is simply projecting the cash flow of a company. When it comes to investing, everything revolves around cash flow. If a company cannot generate cash flow, it's obviously not a good investment. If I would ask you to choose between $1 million today and $1 million in 10 years, which one would you choose? Obviously, you'll choose the $1 million today, because let's say 100 Rand today is not worth the same as 100 Rand in 10 years. That is obviously what we are trying to determine here. So the discounted cash flow model evaluates an investment by discounting the estimated future cash flow. So what do we have to pay for a business today to generate a certain amount of cash flow in the future? And this is where we use the discounted cash flow model. So that is a very simple way of looking at the discounted cash flow model. Again, there's a lot of stuff that we can change and play around with. If you are a member and you have joined my lowest tier of memberships, you will have access to the sheet. So feel free to join the program and you'll get access to sheets like this and my property investment analysis sheets. So there's a few other things that we need to be able to understand, like fundamental analysis, meaning you have to run the numbers on a balance sheet, the income statement, and the statement of cash flow. There's also a lot of other metrics that we need to understand to determine what a company is worth. With that said, I really do hope that you enjoyed this video. If there's some special requests, let me know down in the comments. I'll see you guys in the next video. Cheers.